Volatility-based entry timing is a powerful approach traders use to determine the most effective moments to enter the market, especially in fast-moving environments where price swings can either create opportunities or amplify risks. Instead of focusing solely on static price levels or indicators, this method relies on understanding the current state of market volatility and aligning trade entries with periods that offer the best risk-to-reward potential. High volatility often signals increased market activity, which can result in strong price moves in either direction. For traders, entering during these periods may allow them to capitalize on momentum-driven trends, but it also demands careful position sizing and risk management to avoid being caught in erratic swings. On the other hand, low volatility environments often precede significant breakouts, making them ideal for breakout strategies where traders anticipate a sudden price move after a period of consolidation. Tools like the average true range, ATR, Bollinger Bands, and volatility indices help traders gauge volatility levels and adjust their timing accordingly. For example, if ATR readings show an expansion phase, it may indicate a good opportunity for momentum-based entries, while a contraction phase could signal that patience is needed until the market provides a clearer directional move. Volatility-based entry timing also plays a crucial role in avoiding common trading pitfalls, like entering too early during uncertain conditions or chasing trades after big moves when the probability of reversals increases. By waiting for volatility to align with their strategy, traders can improve the accuracy of their entries and reduce unnecessary stop-outs. This approach is especially useful in binary options, forex, and futures trading, where precise timing can make the difference between a successful trade and a loss. It also supports adaptive strategies, allowing traders to adjust their aggressiveness based on market conditions, scaling in during periods of high volatility and taking a more cautious approach when volatility is low. For beginner traders, understanding how to read volatility and combine it with other factors like trend direction and support resistance levels can significantly improve their performance. Rather than entering trades randomly or based on emotional impulses, volatility-based timing encourages discipline and data-driven decisions. It helps traders anticipate when the market is likely to move significantly, allowing them to position themselves early and avoid being caught on the wrong side of sudden spikes or drops. As markets in 2025 continue to exhibit unpredictable behaviors due to economic events and algorithmic activity, mastering volatility-based entry timing can give traders a clear edge in adapting to changing conditions and staying ahead of the crowd.